Ever wondered who really pulls the strings of the global economy? It's not always the presidents or the CEOs you see on TV. Often, the real power lies with an institution that works behind the scenes, the central bank. And over the last few decades, they've quietly rewritten the rules of how wealth is created and distributed. Let's dive into how they did it. For most of history, money was tied to something tangible, like gold. This was the gold standard. It meant a government couldn't just print more money whenever it wanted. The amount of currency was limited by the amount of gold in its vaults. This system provided stability, but it was also rigid. If a country needed to stimulate its economy during a downturn, its hands were tied. It couldn't just inject more cash into the system, but that all changed. In 1971, the United States officially severed the link between the dollar and gold. This move ushered in the era of fiat money, which is currency that a government declares to be legal tender, but it isn't backed by a physical commodity. Suddenly, central banks like the Federal Reserve had a powerful new tool. They could control the money supply. They could print more money. So, how did this rewrite the rules of wealth? Think about what happened after the 2008 financial crisis. To prevent a total economic collapse, central banks around the world, led by the U.S. Federal Reserve, did something unprecedented. They slashed interest rates to near zero and started a massive program called quantitative easing, or QE. QE is basically a fancy term for creating new money electronically to buy government bonds and other financial assets. The goal was to pump liquidity into the financial system, encourage banks to lend, and boost spending and investment. Between 2008 and 2014, the Fed's balance sheet exploded from less than $1 trillion to over $4 trillion. They essentially injected trillions of dollars into the economy. This had a huge impact. On one hand, it probably saved the world from a second Great Depression. Credit markets unfroze, and the global economy slowly started to recover. But it also had some massive, and arguably unintended side effects on wealth. When central banks buy up all these assets, it drives up their prices. Stocks, bonds, real estate, everything that can be bought and sold saw its value soar. If you were an owner of these assets, you got a lot richer. The top 10% of households, who own the vast majority of stocks and bonds, saw their net worth skyrocket. It was a golden age for investors. But what if you weren't an investor? What if your wealth was primarily in your savings account or your salary? Well, you didn't do so well. Near zero interest rates meant your savings earned virtually nothing. In fact, when you account for inflation, you were likely losing purchasing power every year. And while asset prices were booming, wage growth for the average worker remained stubbornly slow. This created a massive divide. The wealthy, who owned assets, saw their wealth multiply, while the middle and lower classes, who rely on wages and savings, were left behind. The gap between the rich and the poor widened significantly. The rules of the game had been changed. It was no longer just about working hard and saving money. The new path to wealth was about owning assets that would be inflated by central bank policies. And it's not over. We saw a similar playbook during the COVID-19 pandemic. Central banks once again stepped in with massive stimulus, pushing asset prices to new record highs, even as the real economy struggled. So what does this all mean for you? It means understanding that the financial world we live in is heavily influenced by the decisions made by a small group of people at central banks. It highlights the importance of financial literacy. Understanding how assets, inflation, and interest rates work is no longer optional. It's essential for navigating this new economic landscape. The game has changed, and knowing the new rules is the first step to playing it successfully. Thanks for watching. If you found this breakdown helpful, do not forget to like this video and subscribe for more content that decodes the complex world of finance and economics. See you next time.